First off, welcome everyone. Thanks for joining us this morning. I'm Tatiana Davern with Arizona Realtors. I'll be here throughout the webinar today, helping Sandy out. Alongside Sandy, are Melissa and Elizabeth. They'll be here answering the questions that they can in the chat. Today's webinar will be about an hour long. It is recorded, so if you do need to hop off or leave for any reason, I will send everyone the recording afterwards. Let's see here. If you would like to keep your cameras on, that's completely optional. If you would like to turn them off, that's fine as well. The only thing we ask is that you remain muted. If you have any questions, you can go ahead and put them in the chat, and to help us distinguish between questions and comments, please go ahead and just put a question mark in front of your question. So joining us today is Sandy Botkin. He's a CPA tax attorney and has been training millions of small business owners how to get their taxes down. So we're in for quite a treat with this presentation if you haven't heard him speak before. So welcome, Sandy, and I'll go ahead and pass it to you.
Well, thank you, Tatiana. And hi, folks. I just want to say thank you for being here. I got to tell you, today's topic is so critical for you to understand because we're in the midst of some really unprecedented changes in our economy. And a lot of these changes are really not good for you. Some of them are, but most of them aren't. However, throughout history, there are many who know that change creates opportunity. It's always been that case. And since you're here proactively, I know that you're poised to take advantage of good strategies and frankly come out on top, which is what our goal is to be. Right now, as I see it, the two greatest threats to your wealth, if you had to ask, what are the two greatest threats? I would say it's hyperinflation and taxes. There's very little doubt in my mind that those two are it. Before we get started, let me give you, first of all, a little background about me. They did a little cartoonish version because this probably looks better than I am. I've been lecturing for many years with the Tax Reduction Institute. I'm president of the Tax Reduction Institute. Many of you probably have come to my seminars. I'm a best-selling author of a number of books that I think many of you would like to have, one of which is called Lower Your Taxes Big Time, which was an Amazon bestseller. And the second book, which has garnered some terrific reviews, is called Achieve Financial Freedom Big Time. And I've been a guest tax expert on Fox, CNN, CBS, CNBC, and a whole bunch of others. I had my own radio show. And I'm not saying this to impress you. I just want you to know that I know what I'm talking about, and that's why I'm covering this information. It's no secret. I'm not giving you some inside information that inflation's running high. In fact, it's higher than it's been in almost 3 decades. What is it, 7% from last year? I think this past year has seen the largest 12-month jump since 1990, if I did my research right. A dollar just 1 year ago, that's what we're talking about, is the equivalent of $1.07 today. If you apply this to every area of your life, then you can see how big an overall impact this can have on your finances. Costs are clearly going up like crazy. Consumer prices are climbing the fastest pace that certainly in 31 years that I've seen. In fact, here's a sampling, just a little sample of what's happening in most neighborhoods. As you try to, and I want you to take a look at this. Gas, for example, is up 42%. This is unbelievable. Buying a car, all right, costs you 25% more. And if it's a used car, it's even more. Rental cars are almost 43% more per year. Meat and eggs, which are basic staples, are up 10%. Electricity is up 15%. Hotels, 18%. I mean, I can go on and on. And the list doesn't stop here, by the way. So what's causing this inflation factors? First of all, identifiable factors. There was a huge surge in consumer demand. And let's face it, we've all been cooped up with COVID, and now we're finally able to get out, okay? So manufacturers are still playing catch up after last year because consumers increased their purchasing of durable goods during the pandemic. I mean, heck, I can't speak to you, but I bought a computer, I bought exercise equipment. We bought a lot of things. I'm sure the same thing is true with you. If you combine this with a labor shortage that's currently going on, they're scrambling to keep up with current demand. And I don't care where the industry is, labor shortage in restaurants, in hospitals, I mean, all over the place. The second factor is lagging supply. So you have much greater demand, but lagging supply. Suppliers are trying to iron out the supply chain issue, which, by the way, is a global issue. It's not just happening in the United States. It's not just the truckers, by the way. It's all over the world, and trying to keep the shelves stocked. So this really has created a perfect storm. And I've always said that when you have free money, and I don't care like the subsidies that they were giving out, you're going to create an inflationary environment. There is no free lunch. If you give away a lot of free money, you create inflation. And don't get me wrong, I think the subsidies were necessary during the COVID situation, but it helped create the inflation. So if you're paying all, basically you're paying attention to all this stuff, you have to guess whose dollar also is going up besides ours, and that's the government. They're paying attention to this. So the government is also getting hammered. So what do you think that they're going to have to do at some point? They're going to have to raise prices as well, which means, you're hearing this in 2022, so you're hearing me say it, the government is likely to increase taxes. You can bet on it. You can put your money on it, okay? It's a double whammy, folks, because they're going to have to pay more in Social Security, more in payroll, more in goods and services that the government is getting. All right, so knowing that, what can you do about it? Here's the deal. You can make your dollar go further by cutting unnecessary costs. That's one way. And as a business owner, you're likely to have tools in your little tool belt that you haven't taken advantage of yet. In fact, let me give you something that's interesting. Did you know that taxes are the biggest expense that you have in your life? That's right. You're going to spend more on taxes than you will on food, shelter, transportation, and clothing combined. So if you're going to try and cut costs, if that's where you want to put your energy, doesn't it make sense to try and cut your biggest expense first? You'll get the most bang for the buck, don't you? Okay. The good news, and this is something that I think you're going to like, is I can help you with this. Did you know, a little interesting factoid, that over 90% of business owners are overpaying their taxes? It's actually 93%, by the way. That's 93%, folks. And I'm not the only one who's saying this, okay? It was said by, what's his name? All of a sudden, I can't think of his name. Guy was head of the American Institute of CPA, said the exact same thing. Forbes magazine had a whole article on how people are overpaying their taxes. This is money that you are essentially giving away to the IRS. You're not even getting a charitable deduction. And by the way, trust me, the IRS doesn't deserve the money. They don't deserve extra. Trust me. It's time to stop giving away your hard-earned money and start keeping it for you and your family and your business, especially given the dramatic rise in inflation. I'm not saying you shouldn't pay taxes. I'm just simply saying you should not pay more than the legal minimum required by law, period. Okay? So today, we're going to debunk, I think, some incorrect thinking about taxes that's keeping you poor. Then we're going to cover 3 specific tax strategies that you can do to stop overpaying the IRS, okay? And finally, we're going to show you what you can do in the future to lower your taxes to the legal minimum, I should say. And because I got to tell you, this is going to mean more money in your pocket. How's that sound? So be now and in the future, okay? I think you're going to find this to be a very beneficial program. All right, first of all, I want to talk about why over 90%, I said over 90% of business owners overpay their taxes, because you can't solve the problem unless you know why it's happening. Does that make sense? Okay, here's the problem. First, our tax code has gotten increasingly complex over the tax years. I mean, to be honest with you, we really had a good tax code about 50 years ago. It wasn't that hard to understand. It really wasn't when I first was in college. What happened was, what cost the tax code more than anything was a stripper by the name of Fanny Fox. That name ring a bell? She was in a car with the head of the House Ways and Means Committee, and who understood taxes very, very well. He was actually very knowledgeable, that guy. Wilbur Mills, by the way. He was actually the last real guy to understand tax policy. And he got into a car accident with Fanny Fox, and he lost his job. Basically, they voted him out of office. Since then, the tax code has never been really, they've never really had a good person in the House Ways and Means Committee, okay? So the tax code has gotten more complex over the years improperly. And the tax industry has not been able to, frankly, adapt themselves properly. It's easy to see this when you compare the average business owner with what the ultra wealthy do. Now let's look at an example of how an average business owner does taxes compared to the very wealthy, because I think you'll see a very significant difference. Because one thing about a tax lawyer is I've dealt with some very, very wealthy people. So I'm on the inside of a lot of this stuff. The wealthy has armies of tax attorneys and CPAs that work for them full-time, not part-time, to find the best tax deduction to take. And this is true of Sam Walton. This was true of Mr. Wonderful. This is true of all these people. I mean, they all meet this criteria. Here's the key. They are proactively looking for ways to save on taxes throughout the year. Okay? That's a very important point. Now, I want you to contrast this with what most of you are doing, and true for most small business owners, who only hire someone to file their taxes once a year. And not only that, they share that accountant, that same accountant, with 300 other business owners, at least, or more. So you basically get 1/300th, if you're lucky, of the focus of that accountant. Now, before you go blame the CPA and say, oh, maybe I should look for somebody else, let's have a little empathy for them, okay? Because frankly, they've been given a tough job. They're basically the victims, too, of a rotten system. They have 300 clients that they have to file their taxes within about 8 weeks of the year, because you don't get your information until February. They literally have only 2.5 hours. You take a look at how many, let's say they do 7 tax returns per day. They have only 2.5 hours on the average to do those returns, 2.5 hours. And here's where the disconnect is. The wealthy are proactively looking for tax savings in advance. The business owner is reactively filing their taxes once a year. The average Joe or Mary, whatever the name is, confuses tax filing with tax planning. They are basically two different things, and they're very, very different, by the way. If you want to save money in your taxes, you need to be proactive. I can't emphasize that enough, and do some planning. You got to be prepared to spend some good money on planning in addition to your tax filing. A lot of times people say, oh, he wants to charge me for planning. I'm not going to do that. I'm already paying too much for my return. That's the wrong attitude. It is so worth it and will help you keep the money that you earn. Now, if you really want to save money for the rest of your life, you'll take this to heart. There's a better way that doesn't cost you nearly as much as having your own personal accountant. And that is to get a little coaching and how to play the tax game. And this is what we do at MidasIQ, just so you know. We teach people just like you, how to think about taxes. And we show you what the wealthy are currently doing, so you can copy some strategies into your business, okay? In fact, we have a community once a month where we do financial workshops about specific tax strategies used by the wealthy. And we show people all the ins and outs of the strategies so we can start to do the same thing for your business. And then we do group Q&A, which I think you find is very, very important to answer questions. And we also have certified tax preparers. This is something very important because people always ask us, well, who knows your material? These are people who you can talk to on the phone to get answers and guidance, and they are familiar with our material. That's a very important point. And plus, by the way, you get access to a private Facebook group where we post insights and answer questions. Okay, you could easily save, I would say, $10,000 on the average in new found money every single year on what we generate. However, many of our customers, I got to tell you, save 2 and 3 times this after going through the program. You think about that, that's a tremendous amount of money. Now, for the rest of our time together, I want to show you a few things about the amazing tax strategies that we talk about in our MidasIQ program and start educating you. And I also want to give you some real solid takeaways, okay? That's something that's very important to me. At the end, if you want more training, I'll give you a discount link to join our MidasIQ program that was negotiated by the board, okay? No pressure, let's save you some money. Ready? We're going to start with how to save a ton of money on healthcare. That's a big, big issue. And I want you to listen here. Healthcare costs were skyrocketing because this is before inflation started, by the way. Imagine what's going to look like now, where they're paying double and triple to nurses because what's happening because they can't get them. Most of you are probably familiar, and I'm going to cover a couple things, with known as an HSA, otherwise known as a health savings account. And basically what an HSA is you have to have a high deductible health insurance plan. There's usually a minimum deductible, like $1,300 for single and like double that for family and stuff like that, to qualify for this HSA. Basically, it's an account that you can set up pretty easily with a financial institution. Some banks even offer HSAs. And there's a handful of online resources that'll get you started as well. Basically, you put money into this bank account, you get a deduction, and when the money comes out, it becomes effectively tax-free for medical and dental expenses. Not a bad deal. So with an HSA, essentially you're funding an account to be used for medical and dental purposes and other medical and related medical stuff like eyeglasses, contact lenses, things like this. It's a great way to supplement your health insurance. Now, one of the most compelling things about an HSA is that any money you fund the HSA with, and I want to make a big point about this, is tax deductible. When you put it into the bank account, you get a deduction. You can put away this year up to $3,650 if you are single, or if you have a family. Family is 2 or more people, $7,300. Okay, so that's the amount you can put away each year. You basically want to max out your HSA each year, and that's a nice way to save money for future medical expenses and gives you a nice deduction. And you don't have to itemize; you still get this deduction right off the top. Okay. Also, HSAs are not a use it or lose it kind of situation. Okay, it means that you can continue to contribute to the program. It can grow a lot for any health related issues that you can use in future years or even in your retirement. So you don't lose it. You can always use this money. Okay. Now, an HSA is a great tool. All right, and everyone should have one. But I think there's an even better tool, one called a health reimbursement arrangement, otherwise known as HRA, health reimbursement arrangement. And this is honestly a very little known strategy, but it's been in the tax code since 1955 and could save you a ton of money next year. It saved me well over $12,000 in braces for my kids in 1 year. So does that sound exciting to you? I think it should. The way it works is the government allows a company to set up a special benefit plan for employees. So you got to have an employee. I'll show you how to do that. One of these options is to set up a benefit plan and reimburse all employees for their out-of-pocket medical expenses for things that the insurance policy doesn't cover. Now, you don't hear much about this because many large businesses don't want to take on the risk of reimbursing employees for all their medical and dental expenses. Frankly, they couldn't afford to even if they wanted to do that. But the situation totally changes if you're self-employed and you or your spouse is the employee. That's the key here. So let's run an example. Let's say that Mary has $10,000 of out-of-pocket medical or dental expenses this year. Things like deductibles count towards that $10,000, braces, crowns, stuff like that. So there's a lot of things that count. Now, normally, you don't get to deduct these costs other than writing off your insurance costs. But if Mary, because there's a high threshold with medical, but if Mary has an HRA, a health reimbursement account, she could pay for these costs, pass the bill on to her business, so she gets a business expense for the reimbursement. There is no threshold. This is a way of getting around the threshold. No threshold. So she gets a full deduction. So it's fully deductible. And she essentially gets that $10,000 tax free. It is not included in her income. Not bad, right? Okay. Now, these plans can be a pain in the neck to administer. And then the way you do this, by the way, is you simply hire Mary. She hires her husband to go work for her, do some bookkeeping, do some marketing, whatever. And by hiring him, she makes him the employee on this HRA, and then he elects family coverage, which means he covers her and any children, dependent children. So you hire your spouse, and then they cover you. If you don't have a spouse, you can either incorporate or you can do the HSA. Okay, just so you know. Fortunately, as I said, you need these plans used to be a pain because you need to administer the plans. You have to have a fiduciary. But fortunately, there are companies now that do this for you, so they're not a pain at all. And the one that we recommend is a company called Total Administration Services Corporation. Basically, it's TASC, TASC for short. Okay, TASC can automate the whole process and make the paperwork all for you. Make sure that it's done correctly. Now, there are some special exclusions and rules to qualify, like your business has to have an employee, being your spouse, or it could be you if you're incorporated. So we recommend in hiring your spouse if you're not incorporated. That's the key. All right. If you want more information, and by the way, just so you know, the average savings of an HRA average is $5,984 in tax savings. This is not in deductions. This is tax savings. Okay. This is the average. I saved over $12,000 in braces alone. Okay. If you want more information, I want you to go, you'll see a link here. Go to hra.MidasIQ.com. That's hra.MidasIQ.com. Write it down. It's here. That's where you go. And there's a quick quiz to make sure that you can qualify for the HRA. So you want to take that quiz. So again, that's hra.MidasIQ.com. All right. And you also get a special offer. You also get some discounts that we negotiated for you. So there's a lot of good things here. Okay. Moving right along. Now, here's another strategy. How would you like to be able, a lot of times people ask me, my kids are going to college. Can I deduct that? And the answer is no. They're going to get married. Is that deductible? No. Wedding? No. How about a car? Is that deductible? No. How about room and board and books? Nope. Despite what I just said, how would you like to deduct the equivalent of your kids' hobbies, college tuition, future weddings, car, everything I just said, and get an equivalent of a deduction for those things? Right. Would you like that? If this doesn't knock you out of your chair, folks, I don't know what to say. You all need an enema, which, by the way, is deductible under the HRA. All right. Normally, you can't deduct any of this, but there is a way. And here's the answer. Hire your kids and or grandkids. Now, this works best for someone that you're going to support financially anyway. Okay. You don't want to support you don't want to necessarily hire my grandkids. You can, but you want to hire your grandkids or kids. If you do this and you pay them a reasonable wage, they can then pay for their own hobbies, pay for their own college tuition, future wedding costs, etc. And because it's a wage that you're paying them, you're getting to write it off, because wages in your business are deductible, are they not? It's something that the wealthy do all the time as soon as they find something for their kids to do. So here's the basic, okay? 1, pay a reasonable wage. 2, you want to keep timesheets. Somebody talking?
Okay, fine.
Somebody on, you need to mute your line if you're on, by the way, Melissa, or anyone else. So you want to keep timesheets. Number 3, the first $12,950 is income tax free to anybody you hire. Now you might wonder, why is that? Because they get a standard deduction, which has gone up, by the way, to this, against wages. So the first $12,950 that you pay your kids or grandkids is tax free. And if they're under 18 and you're self-employed, there's no Social Security and no federal unemployment tax. So think about this. No Social Security, no federal unemployment tax for hiring your kids, yet the first $12,950 is income tax free, and you get a deduction for the whole thing. I mean, if we don't have good tax laws, I don't know what is. That's fantastic. Now, children, people ask me, well, how old can I hire a kid? Children have to be of an age to actually do the work that you're paying them for. For example, are they old enough to hand out flyers? Are they old enough to do cleaning around the office? Can they do filing? Can they do deliveries? If they aren't, you can't hire them. By the way, just for the record, there is a case that says you can hire kids as young as age 7. So if you want to know what the minimum age is, as long as they can do work, you can hire them as young as age 7. All right. Now, I don't have time to get into all the documentation and requirements today for hiring relatives. I mean, I could do a whole seminar on this, but we do cover this in depth. Hope you get set up with the program once you get up in the MidasIQ program. Okay. This is one of the things we cover. But basically know this, you must really keep good records. Here's an example of a timesheet. That's one of the things you want to do. And you can get these timesheets in Costco, in Office Depot, and online. You can get them all over the place. Get them in your accountant's office. They keep timesheets. So the government's going to want to see better documentation that your children or spouse are actually doing the work. See, if you hire me, IRS couldn't care less, but you start hiring your kids and children, they care. And you want to make sure your I's are dotted and your T's are crossed. That's the bottom line here. But let me give you an example of how powerful this trick is. I needed a new website. And I don't think people always understand how important it is what I'm saying to them. So I want to give you a really good basic example. My daughter was in college and she was majoring in digital design and had some skills. And digital design is basically web design with some miscellaneous animation and some other stuff. Well, I got a couple quotes to design my website, and I wanted some bells and whistles and a bunch of other stuff. And the quotes came in at $40,000 for the website. So you probably figure, boy, that's one heck of a website. It really was. It was a good website. So basically, I hired my daughter and I asked her, can she do what the web company wanted to charge me for? And she said yes. So I hired my daughter for something less than $40,000. Okay. And she built my website. Then she used that money to pay for college. So essentially, I deducted the equivalent of her college tuition, books, and supplies. See how this works, folks? I deducted it as a wage that I paid her for doing the website. Now, it could have paid her as an independent contractor too, by the way. So I could have done that too, same thing. Now, there's more to the rules than this, by the way, and we don't have time to get into it today. There's a lot more in this, but this is just one way the wealthy is keeping their money in their family. And if you're not doing this, you're one of that 93% that's overpaying their taxes. I'll be honest with you. And I've hired my kids to do other things, work on rental properties and do all kinds of stuff throughout the years. Okay. Now you might be thinking, now, Sandy, you said the first $12,950 was tax-free, but wait a minute, you paid her almost $40,000. Well, that's true, but I'm in a much higher tax bracket than my daughter. So we still came out ahead. Okay. Let's say I'm in the 37% tax bracket and my daughter on anything beyond $12,950 is in the 12% tax bracket. That takes federal and state into account. So yeah, she'll pay 12% on that amount left over after the standard deduction of $12,950. But this means that she would pay $3,246 in taxes. Whereas if I kept that money, didn't pay my daughter, I would pay at my bracket $14,800 in taxes. Oh, and I'd have to pay her tuition, by the way. So she'll end up paying a bit, but she comes out ahead by over $36,000 and the income she needs for that tuition. I want you to think about that. Okay. Now, most business owners, I think, over another interesting strategy is the strategy 3. They really overlook their retirement. They're not maxing what they should be doing. But you can put away this year up to $61,000. And actually, I'll show you where you can put away more than that into retirement accounts and take a deduction. So let's look at 2 options for retirement plans right now. I want to give you 2 options. And again, I could spend the whole day on this one, but I'm just going to give you 2 options. One option is the simplified employee pension retirement arrangement, otherwise known as a SEP IRA. Okay. This traditionally has been the most popular retirement plan for self-employed individuals and small business owners. A SEP IRA is a pure profit-sharing plan. That's really what it is. And it allows you to contribute up to $61,000. Basically, it's 20% for sole proprietors, 25% for corporate employees, but basically 20% up to $61,000 for 2022. I'm giving you the latest numbers, by the way, folks. Okay. The particulars include, to give you some particulars, it is a pure profit sharing plan. Okay. No employee deferrals. Okay. Number 2, the contributions are pre-tax, which means you get a deduction. It's before tax. Distributions are subject to tax. And once you hit age 72, you got to start making distributions. We call them required minimum distributions at age 72. There's what is known as a 3 out of 5 eligibility rule, which means you must include employees in your plan who have worked at least in any of the last 3 of 5 years in your company. So if they've worked for at least 3 out of the last 5 years, you have to include them in this plan. Okay. Now, the second type of plan is called a solo 401k plan. And this consists of really of two parts. There is an employee salary deferral contribution and a profit sharing contribution. So essentially two things. In 2022, the total contribution for this 401k is also $61,000. But if you're age 50 or older, and I don't want to know how old you are, by the way, but if you're age 50 or older, you get what they call a catch-up contribution, where you can put in another $6,500. So essentially, you can put away $67,500 in 1 year for this plan if you're age 50 or older. Now, the employee contribution, the way it works, the employee portion, the limit is $19,500. So you can actually have a deferral of $19,500 as an employee, and then an additional $6,500 if you're age 50 or older. These contributions can be really up to 100% of your self-employed compensation. So you're not limited to 20%. This can really be up to 100%. But the limit is $67,500 if you're age 50 or older, or $61,000 if you're under age 50. An additional contribution can be made for the profit sharing plan. Now, what's interesting about this is you can also set up something known as a Roth 401k. Now, what's a Roth 401k? A Roth 401k is the exact same thing. You can put away $19,500 as an employee and the rest in the profit sharing plan. The difference is that the $19,500 is not deductible in the Roth 401k. Now, you might wonder, well, why do I want something that's not deductible? The answer is very simple. What did I say is going to happen to taxes? It's going to go up. With a Roth 401k, you never pay taxes on the distribution. And not only is the money tax free, but there's no required minimum distribution as you get older. So tax-free money and no required distribution. And when you consider when taxes are probably going to go up, that Roth 401k is a good deal. And that applies to the $19,500 you're putting away, not to the profit sharing portion, just the $19,500. So there's a lot to know here. I'm covering a lot of things. Just so you know that I like 401ks. I also like the Roth 401k even better. And for those of you making huge amounts of money, if you're making $500,000 a year, $600,000 a year, there's something called a defined benefit plan where you can put away up to $245,000, depending on your age, a year. Basically, essentially, you tell your accountant what you want to receive. You don't put away a certain percentage of your money, but what you earn, but you tell them what you want to receive, and then they hire an actuary and they figure out how much you can contribute up to $245,000 so you can get that money. And that's called a defined benefit plan. Now, I can go on and on about this, okay? I don't have the time, all right? There's a lot I want to cover today. So let me give you a couple more strategies. You know, this is a very content-rich program, in case you haven't figured that out yet. Oh, by the way, you are going to be getting a recording of this. You will have access to this recording. So if you can't write as fast as I'm talking, don't worry about it. You will have access to the recording. You know, our goal is to put money in your pocket, not to overwhelm you with information. So I'm going to give you some more strategies. Are you a two-car family? If so, I highly recommend you consider driving your spouse's car, particularly if they are not writing off their car. You want to do this occasionally for business reasons. Why is that? Let me walk you through an example. All right. I want you to look at this chart for a minute, where we're comparing driving 22,000 miles on one business car versus splitting it for two cars. This person drove one car. Their spouse didn't write off their car. The spouse didn't have a job, or was an employee, I think, and didn't write off the car. So on 22,000 business miles, they put on a total of 24,000 total miles. The business use was 92%. Now, what does that mean? 92% of the gas, oil, insurance, and so on was a write-off. When you take all that plus the depreciation, they were able to write off $12,348 by using one car in business, 92%. And by the way, let me ask you a question. Do you think 92% is pretty good? If you said yes, you're settling for mediocrity. Let's say we split up the 22,000 miles. We put 18,000 miles on your car. But now we drive your spouse's car, which isn't being written off, a couple thousand miles, let's say 4,000 miles. Notice 18 plus 4 is the same 22,000 miles for business. Where you go from day to day hasn't changed, all right? You're just changing cars every so often. Maybe you drive their car for 2 months or 3 months. The total mileage for the year, instead of 24,000, is 20,000 on car one, but 7,800 because you have some other mileage in business and personal on car two. the business use percentage dropped. It dropped from 92 to 90. You might say, oh, that's a horrible deal. But by using a second car in business, you're able to write off 51% of the second car. If you look down at the very end, this results in almost $4,000 more of a write-off than you would have gotten had you just used one car with a second car not being written off. So this strategy works phenomenally if you have one car that's not being written off. Now, if both of you are writing off your car, you're both realtors, you don't need to switch off. But if you have one car that's not being written off, this is a gold mine that you're missing. Okay, so obviously it depends on your car. But if you drive expensive cars, this could be much, much higher. You're driving a Mercedes or two Mercedes, for example, and you're only writing off one car. This could be 10,000, okay, a year. This is per year, by the way. Now, another thing that works very well for the wealthy is they basically figure out how to combine business trips with pleasure. They also hire their spouse to help them in their business and often plan the trip so they can write off taking their spouse to seminars and conventions. There are very specific rules here, but the point is, if your vacations are deductible, you can afford them more easily, correct? You know, there's an old saying in Washington, D.C., where I live, everything is cheaper if you get a deduction, cha-cha-cha, okay? Now, here's another strategy that allows the wealthy to deduct some equipment. How would you like to write off all the equipment they use in business, not once, but twice? Would you like that? Bet your accountant never told you this one, folks. Here's how it works. You already have assets that you've depreciated. So now you've already written it off, which means you've deducted it once. Now what you do is after you've written off the car or the computer or the telephone or the cell phone or whatever, you give it to your children or another relative, maybe your grandchildren, your nieces, your nephews, maybe your brother, sister, parents, whatever, people you want to support, and then you lease it back from them. Now, so you're essentially, what's going on? You have depreciated the equipment. You're now deducting the monthly lease payments. You're deducting that equipment twice. What you're doing is essentially giving the relative a passive stream of income that you get to write off. Now what can they use that income for? They can use it for college. They can use it for weddings. They can use it for rent, whatever. Now, there are some pretty strict rules about this on what you should and shouldn't do. And it works best for people that are at least age 24 or older, just so you know. It's an incredible way to support members of your family and to avoid paying income tax. It's called the gift leaseback technique. It's a tremendous technique. Now, I want to talk about deducting something else that's a big deal, and that's home office. You know, you probably heard that claiming a home office will trigger an audit and it's not worth it. Well, I'm here to tell you that in 1999, Congress liberalized the home office rules for Americans. In fact, Canadians did the same thing, by the way. I want you to ask yourself a question. For those of you who think that I don't know what I'm talking about, why would Congress, all right, and Canada for that reason, why would both governments change the law and implement the home office deduction, make it easier, if they didn't want the home office deduction used? Why would they make it easier? I want you to think about that. The answer is that it's not a red flag for an audit. That's a huge myth. If you qualify for the home office deduction and don't take advantage of it, you are crazy and you're losing a lot of money. And let's go over this deduction just in a little more detail. As I said, I have a whole seminar on this. For this example, let's assume that the home office makes up, just as an example, 1/8 of the total square footage of your home. Now, there's nothing magical about 1/8, by the way. I'm just using it as an example. Maybe in your home it's 10%, maybe it's 8%, maybe it's bigger, maybe it's 20%. It may be rental property, but the point is, let's assume 1/8 just for the example. Now, what does that mean? That means that 1/8 of your home is used for business, which means that 1/8 of all the expense $27,000. But on roughly a $300,000 home, the value of a home office with interest is worth approximately $15,000 of cash, not deductions, in cash every 5 years. Every 5 years, $15,000. You tell me that's not worth it? And the only reason an accountant would say that is because they never ran the numbers, honestly. Now, to the home office rules, there's some very specific rules. You have to use a portion exclusively for business. So to claim a home office, you have to have a separate identifiable area of your home that you use only for business. And I'm being very serious about this, by the way. It doesn't have to be a whole room, but it can be part of a room as long as it's separate identifiable area. Also, there can be no personal items in that separately identifiable area. So if you have a bookshelf in there, you shouldn't have any cookbooks or fantasy novels in the area. If you have a desktop computer in the office, don't let your kids play computer games on that computer or do their homework on that computer. When I say exclusive, I'm not kidding. And by the way, how do you prove that the area is used exclusively and it's separately? I bet your accountant never told you this. You're about to hear something I bet you never heard. A couple things I want you to do. I suggest you take a photo every year of the area and keep it for evidence in case you're audited to show that it's used exclusively for business. This way, if you get asked, I get asked all the time when IRS agents show up in my home and want to look at my bookshelf and see the home office area and see if it's used exclusively. The answer is yes, they will. But they usually give you quite a bit notice first. Now, I'm not saying you should take advantage of this fact, but they will provide you with notice and state that they're coming. Now, yeah, so that's the second thing. So you also have to use your room regularly for business. And what does regularly means? That means at least 4 to 5 days a week, 45 minutes per day. It has to be your principal place of business. By the way, when you think of regular usage, like 4 to 5 days a week, 4 to 45 minutes a day, what do you think of? Is bathroom, toilet bowl? Is that, think of that? That's what I think of. So also, you don't have another office where you do any administrative work. You could do sales work at the broker's office, but you don't do any administrative work there, okay? So you want to use your home for the majority of your business management and administrative work. All right, let's summarize I like to summarize what we've covered so far today. Number one, inflation is going up, and so are taxes. You can bank on it. To curb this increase, you want to lower the number one expense you have in your family, and that's taxes. There's a difference between tax filing and what you pay for that tax filing and tax planning. I want you to be prepared to pay and pay a lot for tax planning, but I promise you it is worth it. There's no greater benefit than paying for tax planning. In fact, there's a former Nobel Prize winner economist by the name of John Maynard Keynes. Some of you may have heard about him. He said the one major thing that's worth it economically is to reduce your taxes and pay for tax reduction. And that was John Maynard Keynes. He said something like that. It wasn't the exact statement, but that's close enough to what he said. But one way is you can pay for tax planning, which is certainly worth it, or you consider joining our group coaching program, which is MidasIQ, to learn about all the tax deductions that you could be taking, and let us help you implement them. So the tip of the iceberg, first of all, I want you to remember that this is just the tip of the iceberg of what can be done today. I'm really only just touching on things. There are over 400 strategies that we teach, and they aren't hard, but you need to hear about them. Now, I want to do a little 10 to 15-minute Q&A here on the call and answer as many tax questions as I can. But I want to take 3 or 4 minutes for those of you who'd like to maybe get some more information on our MidasIQ program, and then we'll take a few minutes to answer Q&A, okay? First of all, in our program, which is called MidasIQ, I help you tackle the tax code in small doses over the course of a year. I find it's the fastest and best way to learn how to win the tax game. My goal is to save you a minimum of $10,000 or more on your taxes within a year and every year for the rest of your life. How's that? That sound pretty good? First of all, every month, how I do this is I do a live workshop, sort of like this, but it's a little different. Sometimes I might even do 2 workshops actually in a month. But I'll do it, or I usually bring in a financial expert. So we do workshops in a wide variety of areas, not just tax. We show you how to make money too. Like we just did a seminar on social media marketing, for example. We do a lot of different things, all right? So the subjects vary from tax deductions we talked about today to unique topics of interest to business owners. We do, if you advertise on TV, how to get the best prices and so on. I mean, a lot of different things. What should copywriting do when you want to send out ads, okay? What makes these workshops so special, though, is different than a little bit than this one, is how in depth we go in each subject. And you get the opportunity to ask questions of the experts. For example, in one workshop, for example, we cover everything you need to know about your vehicle, which is a big deal. The next month, we'll go in depth on how to figure out how to run the equivalent of your kids' college education and weddings through the business in a lot more detail. Another month, we'll talk about home office deduction and how to get the biggest tax benefits for that. And I'll show you how to really maximize that. And it's all in plain English. So you'll see exactly how you can implement the same fortune-saving ideas used by the wealthy. And you also learn how to make money too, because we bring in people who are experts at that, like social media marketing and so on. Okay. Now, after each workshop, we open up the forum for question and answer session. It's one of our most valuable resources because you get to hear intelligent questions asked by other business owners that you might not have thought of. In turn, this sparks, I think, creative thinking and strategy and uncovers hidden tax gems in your business. Then you build your own collection of recordings and more in your password-protected MidasIQ vault that you can watch anytime you want. In fact, in addition, after participating in our monthly workshops, you unlock a free one-on-one consultation with a MidasIQ certified tax professional. These are people who are paid to understand, to go through our program, okay? And you can ask them any lingering questions. And this is an excellent, excellent resource because it's included for free in the program. Plus, you have access to our exclusive access to our private MidasIQ community Facebook group to connect with other MidasIQ members and get your tax questions answered by MidasIQ certified tax pros who read the questions. In fact, I look at it and many times I answer the questions. I like to read what's coming in so I can prepare for the seminars and see what's happening. In fact, give you an example of some testimonials. Aisha J wrote us. She said, this program has saved me so much money. The first year, it saved me over $13,000 in taxes. Look at that. I'm a lifer. I can tell you that it's averaged at least $10,000 and has saved easily double and triple that $10,000 easily. Here's one. Since I've joined the MidasIQ, I've learned about so many deductions I didn't know about. I have learned the rules of the game. Thank you, Michelle M. Marsha, I have learned so much through MidasIQ. I pass the ideas on to my accountant to keep him proactively looking for deductions for me. Proactively, that's a person who learned something. Thanks for keeping me informed. Here's another one by Paula K. Thanks for Midas. I can honestly say that I'm not worried about outliving my retirement. Thank goodness. Let the Midas team help you turn your dream into gold. I agree with you, Paula. Since I'm semi-retired, I agree. Angela, I now consider myself informed. I feel as though I can advocate for myself with my CPA. Thanks again for sharing your knowledge. T. Bowling, it's been so enlightening as to how many deductions that my CPA has not shared with me. That sound familiar, folks? K. Freeze, I've learned so much about deductions I can take that I will never know that from my accountant. Most specifically about vehicle deductions, home office deductions, and so on. This alone has paid for my MidasIQ membership. Okay, that's enough. Here's the deal. We did a survey a while back, and the average saving reported by a group of our students was over $20,000 after they went through the education. What would you do if I gave you an extra $20,000 per year, folks? Okay, take a dream vacation every year, save for kids' college education and weddings, turbocharge retirement, upgrade to a sports car. How'd you like that? I'd like that. You simply cannot afford to not lower your taxes, especially with the inflation on the rise. You just can't. So normally the price of the program is $129.99 a month. And I got to tell you, it's a steal at that. I mean, if you could save $10,000 to $20,000, that's a steal. But if you sign up today, you can get it for as little as $49 a month when you select annual billing. That's it. You just pay for the year and it comes out to be $49 a month. Seriously, if the average person saves $20,000 and it only costs $49 a month, that's one heck of an ROI. I'm not sure what is that ROI? 5,000%, some crazy number, okay? And I'll even put my mouth where my money is, folks. And here we give a money back guarantee. Try it for 60 days. And if you don't feel like it saved you at least $3,000 in that 60-day period, we'll refund your money. That's it. When it's not going to make you prove to me, you don't have to show, oh, I didn't save it. You don't have to send me your tax return. We'll take your word for it over the phone. How's that? You just attend 2 sessions. That's all we ask, at least 2 sessions. And if you don't feel like you've learned enough to save at least $3,000, just email Scott in our support office, or you can call him and ask for a refund. There won't be any shenanigans. We just want to help you, okay? And I can tell you, we very rarely get a refund because we save people $10,000, $20,000, $30,000. It's that simple. Just go to the link in the comments, okay? It's just that simple. Now, I wouldn't be a good salesperson if I didn't try to sweeten the deal for you. It's the way it is to make the decision now. So here's what I got for you. If you join before the end of the day, I'm going to send you some bonuses. I want you to sign up today and you'll get a free digital copy of my latest book. It's a $19.99 value, plus a free digital back issues of our tax tip newsletter for 12 months. Now that's a $99 value. Those are free. Again, this is for people who move quickly. In fact, here's a slide with a recap of the benefits you'll get when you sign up for the Midas program. Okay, you get a monthly workshop to show the new ideas to drastically reduce your taxes. You get group question answer workshops with me, and I'm a former IRS attorney. You get 15-minute calls with each workshop, by the way, with a certified tax preparer after the workshop to ask questions. You get vault access to our summaries of our recordings if you can't make it, and documents to help you save big. You get access to our Facebook group. It's a private group to post tax questions and get answers. You get our time-sensitive book, 7 Simple Ways to Legally Avoid Taxes. You get our back issues of our MidasIQ tax tip newsletter. And the total investment is only $49 a month if you pay for the year. And you get a 60-day money-back guarantee. Okay? If you're serious about saving money in taxes, I can tell you, I'll see you in the MidasIQ program. Hopefully I convinced you of the horrible mistake of not getting this, because if I didn't convince you that this is a great return on investment, then I must be something wrong with me, okay? All right, that's all I'm gonna say. All right, I'm gonna spend 10 or 15 minutes answering some questions coming in. We may not have time to get all of them all, but I'm gonna bring Melissa back from my office to read me some of the questions. Okay, Melissa, what questions do you have for me? Melissa, can you get on?
Yep.
Okay.
I'm here. Tatiana, are you okay with me asking him, or would you like to?
Nope, you can go ahead.
Okay. All right. So Sandy, let's start with this one right here. They're asking, is the monthly fee that they will pay for MidasIQ tax deductible?
Yes, it is. Absolutely 100% deductible. In fact, everything I do is deductible. I'm a walking deduction.
That makes it even better. All right. This question from Victoria says, can I hire myself from my LLC to me personally? Would I have to file 2 returns?
No, you can. An LLC is this, and you can only hire yourself as if you elect corporate status on the LLC. LLC is a sole proprietorship, by the way, just so you know. You can elect corporate status, in which case, yes, then the LLC can hire you. You're usually better off hiring a spouse and electing family coverage. But if you're not married, you can form a corporation. It could be an S corp or a regular corp, actually, and hire yourself in the corporation. Oh, and by the way, I do want to mention, when you pay for the year, it's not even $49 a month because it's tax deductible. So by the time you get a deduction for all this, the government it subsidizes this about a third. So really, it's going to run you about $30 a month after taxes.
Okay, great. This is a really good question from Susanna. It says, for realtors, what are the write-offs that most of them don't know about?
Oh, there's all kinds of write-offs, Suzanne. I mean, when MidasIQ, we get into all kinds of stuff. And just join Midas, go to the link in the comments section, and it's that easy. I mean, I'll give you one. I'll just give you one right now, off the top of my head. Most people, when they go to a convention or seminar for their real estate business, not only the clothes got dirty. I mean, you're wearing clothes every night. You're wearing a bunch of stuff. You get dirty clothes. So a lot of times they get it dry cleaned at the hotel. But not only, you don't have to do that, because the IRS says that if you take your clothing home, which is a lot cheaper, and get it dry cleaned, as long as the clothing got soiled at the convention, your first dry cleaning bill you incur when you get back home is 100% deductible. And I bet your accountant never told you that one.
Okay.
See, that's the point. Little ideas like that can be worth, 60, 100, 500, 1,000. I mean, it adds up, and it can save you a lot of money. And it's even better than generating more income, because it's all tax-free savings. It's after-tax money.
Yeah, it does add up over time for sure.
Mhm.
We had a question come in that they asked, it says gift what? And I think they're talking about, when you were talking about the gifts, the gift lease back.
Yes.
There's
If
some
you,
ideas.
if you want to double deduct your, I said, how would you like to double deduct your equipment? And after you depreciate, there's nothing else you can write off. So what you do is you give title to the equipment to your relatives, your children, your grandchildren, your parents, whatever, and lease it back. You can use a quitclaim deed. My parents were antique dealers, and they owned all kinds of display tables for the antiques that they had in their shop. What they did is they transferred the title to all of the display tables to my grandmother's. Just use a quitclaim deed. You can get this in Costco, or you can get, it's very easy to get a quitclaim deed to my grandmother, and then lease it back with a lease agreement. So essentially every month, my parents would pay a lease payment to my grandmother after they transferred title, and my grandmother would use that money to help subsidize her living expenses and other things that she did. And that's
Okay.
how they supported my grandmother. Okay.
Right, that's great. The other, we had a question about hiring your kids. This is, how do you actually pay your children? What tax forms, and like what
Okay.
kind of thing is it with?
I get
payroll
it. The answer generally is, we cover this in Midas, but the answer is you would use W-2s at the end of the year, and you would use 940s and 941s, which is for unemployment and Social Security. I do not recommend you do all that stuff. What I recommend is you get a payroll service. A payroll service will do the tax forms. A payroll service will do the filing. A payroll service will even put the money in their account. They'll do it all. What's a good payroll service? ADP, Paychecks. Just go to your yellow pages and look, or go to and look up the word payroll service. Any payroll service can do all this for you.
Okay. Right, and then is there, what entity should a real estate agent be? Is there one that's better than another?
I normally recommend that as a realtor, you start off simple, because you're busy learning the business. You're busy learning marketing. You're learning all kinds of things. You want to keep it simple. Okay. So you want to start off as a sole proprietor or an LLC, any of those two. Now, once you're in business a while and you start making some money, like you're making 200,000, 300,000, at that point, you might want to consider switching to an S Corp. But until then, I would start off as a sole proprietor at first. You want to keep it simple. And I strongly recommend that at first. Now, once you start getting liability issues, like you hire an assistant, stuff like that, at that point, you might want to consider an LLC or incorporated.
Okay, great. Can someone hire their spouse? Like if the spouse is to drive them to showings or deliver flyers?
Absolutely. Can't you hire me? If you could hire me, you could hire your spouse. As long as they do legitimate work for your business and you pay them a reasonable wage for what they do.
Okay, and when you do hire them, does that qualify for the HRA requirements?
Absolutely.
Okay, what if the spouse is retired? Is it still okay to hire them then?
Yeah, well, again, I'm semi-retired. Can you hire me? Can I get a job while I'm semi-retired? Sure. Same thing is true with your spouse. Same thing.
Great. Okay, well, we're almost at 11 o'clock, so let's turn the time back over to Tatiana.
All right. Well, I just want to thank everyone for joining us this morning. And thank you, Sandy. As always, I will be emailing the link out to everyone probably later this afternoon. But if you have any questions, feel free to email me. But with that, I hope everyone has a great rest of their Tuesday. Thanks, everyone.
Thanks, everybody. And let's use the information. Join